All right. Today is Tuesday, the 28th of May. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. And I know, where did you go, Maverick? You disappeared all of a sudden. We had a holiday here in the US. What do you want from people? Can we take a break from the economy and the stock market and all of that for a few days? And I hope that all of you had a good, long, relaxing holiday. And now you're ready to go back to business. Before we begin, folks, we gotta do some condolences here to Shiba Uno. The guy passed out at 18 years old, and it's always sad when they go that young. He was a good guy too. Bought everybody drinks. Rest in peace, Shiba Uno. But folks, we have a lot to talk about tonight, so let's just dive right into it. Now, you'd think that this week is a low volume week. It's going to be a holiday shortened trading week, so gravity to the upside, nothing really interesting going to happen. Maybe we can extend the holiday weekend all the way for another week. Hold your horses here. I think this week is going to be more interesting than a lot of people think. Sure, it is low volume and volume absolutely collapsed so far, but there is a change in volatility coming, and with that change in volatility comes an increase in volume. Hold your horses, we'll talk about that in a minute. And among the events that we got today, in the morning we received new data about the housing market. Of course, they say that inflation is dead and it's gone. You people are just, you like to complain a lot. And of course, the propagandists in the media, they've been saying for a long time, watch out, inflation is going to get crushed. You know why? Because of the lags. Housing prices, rent prices have been collapsing, according to the experts. And there's a lag. It's going to show up in the CPI and then inflation will be gone. Poof. Of course, they said that about 2 years ago. And now we get new updates on home prices. And here's the headline. Home prices reach new high in the month of March, according to the Case-Shiller Home Index. We have witnessed records repeatedly break in both stock and housing markets over the past year. AKA, we still got a bubble in both the housing and the stock markets. You look at these cities: Atlanta 6.1% year on year, Boston 8.7%, Charlotte 7.5%, Chicago 8.7%. Who the hell wants to live in Chicago? Cleveland. I'd live in Chicago, not Cleveland though. 8.8%. LA 8.8%. My former town, San Diego, 11.1%. The highest rate in the nation. And you wonder why I left. But the city that I left to is not doing any better. Las Vegas. Home prices up 7.7% year on year. And to be honest with you, it's not really that cheaper than California. Everything is moving higher here in Las Vegas. Housing, food, services, utilities. Vegas used to be the shelter. If you want to escape California, the living costs in that state, you go to Vegas, close enough, you can fly in 45 minutes, but you'd have a better quality life. You'll have a home with a big yard, with a pool, and you pay cheaper prices. For rents, for mortgages, not anymore. And it's not just Vegas alone, it's a lot of cities in the country, so we see housing inflation still way too high, prices are unattainable, unaffordable, and you have an entire generation that's locked out of the market right now. We talked about the tale of two economies. Now you have folks who own homes, and they're enjoying the high equity price that they can utilize for loans and many other ways to attain liquidity. And then you have the other class that is locked out of the market, and they continue to pay insane rates for rents, because that's the only choice for now. And we see this reality, the divide, the great divide in the economy, the have-nots, more than ever before. Not just when we talk about the demographics, but also when we talk about the sectors of the economy. We talk about the stock market, the haves and have-nots. We'll talk more about this in a minute, but among the important events that we got today, we have U.S. crude oil, the WTI rebounding by more than 3% in a single day. Now, of course, a lot of folks talked about maybe this is geopolitical, maybe this is about Ukraine, maybe this is about Israel. CNBC says maybe it's about the OPEC Plus meeting. I think it has a lot to do with the technicals. And of course, prices have to be manipulated before the Memorial Day holiday, the driving season. You fill your car at the pump, you feel better, and you say, you know what, maybe I'm going to vote for Joy B after all. And then, of course, when they're done deceiving you, stick it back in your ass. They'll do the same way if they get reelected. Thanks for the vote. Now enjoy more inflation, baby. Among the important events that we got today was the zombies from the Fed talking, of course. That's all they do. They tour the country like rock stars on private jets, courtesy of the taxpayer money. And they babble nothing but gibberish. But it seems that the consensus for now, we've heard from the big zombie himself, Powell, and then from other Fed zombies, and the consensus right now appears to be we're just going to hold. And I said, June is the window. You can't really make a decision before the elections if the decision in June is gone. Because if you do it after that, it's going to look political. A rate cut or hike will happen after June only for severe reasons. In the case of hikes, if we see oil prices surging above 100 again. Now, that would only happen if we have a major escalation in the Russia-Ukraine war or in the geopolitical arena. So we can expand and talk about this in another video. But rate cuts will only happen if there's something that breaks between now and then. So for now, it is a pause. Just keep it as it is. Powell said that today. Neil Kashkari came out and said the same thing. Now, this is not good for a lot of sectors of the economy. That yield is going to stay higher for longer because, understand this, if the Fed is not going to cut, then you have to look at the bond market and the dynamics of the auctions and how that's going to play out. Today, we got a bunch of auctions not pretty good, and we saw yields going higher. Now, as yields go higher, that is the equivalent of a rate hike in the economy, because you'll see mortgage rates going higher right away. You'll see credit card rates going higher right away. Auto loans rates going higher right away. And this is why, of course, Janet Yellen, the Treasury Department, the propaganda minister, what she wants to do beginning this week is to buy back treasuries, because she knows that the auctions are awful, and the buybacks of treasuries is just another manipulation tool to keep yields down before the elections. So the Fed is not going to cut. That's not going to happen. If it doesn't happen in June, not going to happen between now and the elections. But what they can do is at least an attempt to prevent yields from going higher. And that's going to be Janet Yellen's job, not Jerome Powell's. Now, let's segue to the main topic of conversation for tonight's video. We talk about the Great Divide. You know, the stock market is almost at all-time highs. And according to the talking heads in the media and the propagandists at the administration, this is the greatest economy we've ever had. So the question now becomes, why do we disagree with that? When I say we, not me and you, I'm talking about the majority of the population in this country. You see headlines like this: why Americans are feeling bad about inflation despite a good economy. Well, if you got inflation, you don't have a good economy, genius. You got CNBC saying why many Americans still feel bad about the economy despite strong data. Because nobody really cares or gives a shit about the data. We all care about the reality. And here we have Axios saying more than half of Americans think that the U.S. is in a recession. It is not. So gee, why is this happening? Here are more details for you. This is really stunning. CBS, they say many Americans are wrong about key economic trends. Take this quiz, test your knowledge. How about you take the quiz and shove it up your ass? I know what you're going to say. You're going to say stock market doing better than ever before, economy better than ever before, inflation is getting crushed. None of this is true. None of this is really felt. If you take the manipulation away, you see a different reality. And maybe this is why we're having the Great Divide. But again, let's just go over the information. The question is the U.S. in a recession? Yes or no? If you said no, you got the correct answer. At least this is the official correct answer. According to who, Maverick? According to the economists, a recession is a slump in economic activity, or when GDP is negative, as the GDP has been growing, fueled partially by consumer spending and government spending, but they're not going to add that, at rates that have exceeded economists' expectations. The U.S. economy is not in a recession. Now, what do you guys believe? Well, here it is. What Americans believe. About 56% of those polled by the Harris Guardian economic poll said that the U.S. currently experiencing a recession. 56%, aka the majority. Here's the next one. How has the S&P 500 index performed in the year 24? Stocks up for the year, or stock market is down for the year, or C, the market is unchanged? If you said A, well, you won, you got it right, but you get nothing really. This is not a game show. The correct answer is A. The S&P 500, a proxy for the broader market, has climbed 11% for the year. Now, here's what you guys believe. What Americans believe, about half, listen again, about half of the people polled by the Harris Guardian said that the stock market is down for the year. Uh-oh. Sound the alarm at the White House, because they sacrificed the economy to keep the stock market higher. It's not working either way. Here's the third question for you. How does the current unemployment rate compare with prior periods? Question mark. A, the unemployment rate is now near a 50-year low. B, the unemployment rate is near a 50-year high. Or C, the unemployment rate still hasn't recovered from the pandemic. If you said A, you got it right.
Check out the big brain on Brad. You're a smart mother. That's right.
The jobless rate stood at 3.9% in the month of April, a near 50-year low. The current unemployment numbers are also similar to levels experienced prior to the pandemic, indicating that jobs lost during the crisis have been recovered. Now, what do you guys believe? What Americans believe? About half say the unemployment is near 50-year high. And here's the last one for you. Is inflation increasing or decreasing? A, inflation is rising. B, inflation is falling. C, inflation is not changing. If you said B, inflation is falling, you got it right again. Inflation, which measures the rate of change in prices, has been declining since reaching a peak of 9.1% in the month of June 2022. In the most recent CPI reading, inflation was 3.4% in the month of April. Now, what do you guys believe? What Americans believe, about 7 in 10, wow, 70% responded that they believe inflation is rising, according to the same poll. And the question now becomes, why do Americans feel this way? Because it's not true. The economy is not, at least officially, in a recession. The stock market is at all-time highs, not crashing. The unemployment rate is at 50-year low, almost, not 50-year high. And inflation is going down, not higher. Now, we read a garbage article, a hit piece, really, against us YouTubers and, quote, financial influencers, end quote. They say that those are the people to blame. With all of the doom and gloom content and tweets, they're influencing the perception of the economy. Oh gee, I didn't know I was that powerful, doing a financial show from my garage. This is, of course, the same garbage of let's blame anybody else but ourselves. I mean, think about it this way. If the media is blaming us for this negative perception about the economy, then with all of the propaganda that you have, with all of the manipulation of the algorithms that YouTube does, to fluff up your content, your propaganda content, and diminish our content, you're still losing. What does that say about you? But this is not why Americans are feeling this way. We'll talk about why in just about a minute, but understand that this is going to become a hotter topic. Why? Because it's now becoming political. You know, the saying goes back in the 1990s, it's the economy, stupid. You can campaign whatever you'd like. When it comes to a presidential election year, it's all about the economy. And with this kind of perception about the economy, this is not good news for the White House, aka the Joey B administration. The Journal says Biden needs more empathy on the economy. Democrats say, oh, empathy now. Well, wait a minute. You guys said that we have the Inflation Reduction Act, that we got Bidenomics. You've been gaslighting us about how great the economy is. Maybe there's a problem there, or maybe there's a problem with this right here. The president often touts strong job numbers, even as voters care far more about inflation. Bingo, there we go. What is the point of having a job? You know, strong job numbers. Yeah, sure, because we're working 2-3 jobs to pay the bills. What we care about is inflation, stupid. And we talked about this, folks, over a year ago. We said it's imperative for the Biden administration to tackle the problem of Jerome Powell, because at the end of the day, the administration doesn't have a magic wand to fix inflation. Inflation is a monetary phenomenon. It's a problem stemming from the Fed, and I said and I predicted that Jerome Powell will cause Biden the elections because Powell is not serious about tackling inflation. Powell's main mandate is to fluff up the real estate and the equities market. Why? To keep the rich richer. That's the job of the Fed. What did President Biden do? He re-elected Jerome Powell, and now he has to pay the price for that. The headline from The Hill reads, even Biden's most reliable voters cannot get past the economy. This is a major problem, folks. President Biden's re-election chances appear to have taken another hit this past week, as new polling showed his approval ratings at its lowest levels in almost 2 years, amid growing economic pessimism and declining support among key constituencies. Indeed, the most recent Reuters Ipsos tracking poll shows that just 36% now approve of President Biden's job performance, tying the lowest level of his presidency so far. Worse, critical parts of the Democratic base are turning away from Biden. Just as the campaign heads into the critical summer months, per Emerson polling, Biden's approval is dismally low among voters under 30-year-old, 26%, black voters, 55%, Hispanic voters, 33%. Not only are those voters unhappy with Biden, but they are also actually becoming more receptive to Donald Trump. The same Emerson poll shows that among voters in their 30s, Trump is leading by 4 points, 45-41, a reversal from 2020 when Biden carried this group. What do you think will happen if you're robbing this generation? Folks in their 30s, they cannot really own a home. They have to work 2-3 jobs, live with roommates, incur high credit card debt to cope with the rise of inflation. The quality of life absolutely sucks. For this generation, in their 30s, they're looking back to their dad's generations. Well, by the time my dad was 28 years old, already was married, had kids, owned a car, owned a home, and he wasn't rich. We were middle class. The American dream was attainable. Nowadays, you're in your late 30s, you cannot afford to get married, you cannot afford to have kids, you cannot afford to own a home, you cannot afford to own a car. That's why this group of voters is getting pissed off to the point where they're actually leaning toward Trump, who was not really that better than Joe Biden. But again, when you look at Joe Biden, it's an absolute disaster that it makes Trump looks better. And the gaslighting on top of that, that's the deal breaker for me. When we look at the realities of the economy, forget about it's about the economy, stupid. It's about inflation, stupid. That's what really matters right now. We showed you this before from the journal. $100 back in 2019 bought you all of these items: toilet paper, flour, crackers, dish soap, eggs, meat, chips. You can see it for yourself. If you want to buy the same basket of items today, you have to pay over $36 more. That is an inflation rate of 36% plus. If you cannot afford the extra 36% plus, and you stick with the $100 from 2019, where you're buying less now, the quality of life has been diminished. So you can gaslight me about how great the economy is, or economist douchebag says that inflation is going down. Doesn't matter. The damage has been already done. And the remedy was to tackle inflation back in 22. Finish the job. Crash the market. Get it done. By this time, we'll be already talking about recovering, and inflation would have gone negative. Prices would have gone down. But of course, they couldn't do that. God forbid we upset the oligarchy. But here's more for you. When we talk about the tale of two economies, the great divide, why folks believe that we are in a recession right now, because they are in a recession. It's not official in the economy, but there are groups among the consumer facing a recession. There are stocks in the market right now that are down 30-40% for the year. And there's only one stock that's really performing. So we'll talk about that a little more in a minute. But you look at overall inflation. Sure, it's been going higher. It's been increasing, but the rate went down. That doesn't mean the prices got cut. Prices are still going higher, be it at a slower rate. When we look at airfare, the inflation there has been cooling, but it's been cooling less. And that's not a good sign for the economy. It shows that consumers have to cut back on traveling. And you saw what happened after the bell with American Airlines stock crashing down big. You look at cars, that's cooling off. Again, not a good sign. It is indicative that with higher rates and a diminishing consumer purchasing power, it's becoming really hard to take loans to buy cars. Folks cannot afford it anymore. We talk about clothing. Inflation is not as hot as it used to, but now it's reheating again. We talked about apparel. According to the recent data, those prices are going higher. You saw from the earnings that we got last week that consumers are now downgrading. If you used to shop at Macy's, Nordstrom, you're not doing that anymore. You're going down to TJ Maxx and Ross Store. Electricity, this inflation rate is getting hotter. You know that. I mean, you're paying for it. You're paying for cable. You're paying for water bills and utility bills, gas bills. They're all going higher at an insane rate. Gasoline prices was cooling, now heating up again. Housing costs, been hot, never really went down. Meat and eggs cooled off for a little bit, now heating up again. You look at the average price for a gallon of regular gas. You can say that it's down from the highs, sure, but we don't care. We look back at 2019, 2018, and the voter says, well, back when Donald was president, I was paying $2.50 a gallon. Now with Biden, I'm paying $3.50 plus. Choice is easy. Then you look at the average price of electricity. That's the one they don't want to talk about. The bills are skyrocketing, folks. The bills are insane, and you know it. We have the summer season now. You watch your bills. They keep going higher and higher and higher. Even fast food prices. When we talk about the quality of life, you look at the hourly earnings since 2017, that is now lagging the inflation in fast food meal prices. I mean, fast food is supposed to be affordable. Not anymore. You look at McDonald's, so medium French fries, $1.79 a piece in 2019 to $4.19 in 2024. A 134% increase. A McChicken, $1.29 a piece in 2019, now it's $3.89 a piece. That is a 201.6% hike. The price of the beloved Big Mac increased 87.7%, $3.99 in 2019. Now it costs $7.49. Now an order of McNuggets 10 pieces went higher by 68.8% from $4.49 a piece in 2019 to $7.58 a piece. Cheeseburgers used to cost you about $1 a piece. Now it costs you $3.15 a piece, a 215% spike. That's of course not including the DoorDash fees and the tips that you have to pay. So again, when these geniuses in the media and the administration ask what's wrong with Americans, they're being propagandized by these YouTubers and influencers. No. It's reality. Did your wages go 215% since 2019? Absolutely not. Wages been lagging the real inflation rate in the economy. Here's more for you. Chipotle. 2019, if you want to buy the chicken burrito, $6.50 a piece. Now it costs you $10.70 a piece. And according to CMG's earnings, the CEO says we're going to jack up those prices even higher. Subway, you want to look for a foot long, $5.50 a piece. 2019, now it costs you $8.49 a piece. Here's more for you. Inflation since Jan 21. Eggs, 49.3%. Gasoline, 47.8%. Airfare, 32.7%. Electricity, 29.3%. Nat gas, 26.9%. Chicken, 23.9%. Public transportation, 22.2%. Used cars, 20.9%. Milk, 15%. Clothes, 13.5%. Over the last 3 years, the purchasing power of the US dollar declined by 16%. Furthermore, over the last 5 years, the purchasing power of the US dollar declined by 23%. Listen to this. This effectively means uninvested money from 2019 is now worth almost 1/4 less than today. How is this a strong economy? ? So think about it. If you have a cheeseburger that's up 215% since 2019, on top of that, you lost 1/4 of your purchasing power. Do you see what's going on in this economy? We have fallen far behind. Only the owner class, real estate investors, stock market investors, and we're not talking about your 401k either. Nobody gives a shit about that. Or your little pennies that you're playing the stock market with. We're talking about the millions, the billions of dollars invested in those. For that class, the super rich, the oligarchy, or the economy's better than ever before. For the rest of us, this is the reality. We lost 1/4 of the purchasing power by the devaluation of the dollar alone. On top of that, you see these inflation rates in critical items. You can gaslight me about all the inflation rates, CPI is about 3-point-whatever%. But since 21, eggs up 49.3%. My wages didn't go up by 49.3%. That's the problem. And that's why folks feel that we are in a recession right now. All of this, ladies and gentlemen, could have been fixed. In the year 23, the Federal Reserve made a choice, and that choice was to abandon the fight against inflation in order to save the stock market. They were doing pretty good. 22 stocks were down, inflation was going down, but then of course, we got really close to a crash. We began seeing financial institutions, SVB, First Republic Bank collapsing, and many more were about to collapse. That was of course what we had to pay to get rid of inflation. And because of that, the stock market would have dropped about 20 to 30% on top of what it dropped back in 22. But that would have fixed inflation. Recession is the remedy of inflation because prices would go down. Housing becomes affordable again. Sure, folks will lose jobs, but for the majority, conditions will improve. Yet the Federal Reserve once again made a choice. And that choice is we're going to abandon the fight against inflation to save the stock market. And they began pumping liquidity back in. They stopped hiking rates. And they began talking about rate cuts. It did the magic. The stock market is back up again, benefiting who? The affluent, the super rich, but leaving those who were suffering from inflation further behind. That's the problem here, folks. And now, this owner class, their stocks at all-time highs, real estate valuations all-time highs. They can take equity loans, they can feel the wealth impact, and keep spending in the economy. They keep inflation sticky. This is not a good economy, again. The have and have-nots, the tale of two cities, the great divide, not a good economy. The rich alone not going to get you re-elected. It's the middle class. It's the backbone of the country that you've abandoned and decided to stab right in the back to save the stock market and real estate market. Well, you got to pay the price, baby. When we talk about the stock market, ladies and gentlemen, of course, because we talked about the economy now. Now you understand why Americans are feeling gloom about the economy. What about the stock market, though? It's all-time highs. Why do most Americans feel that the stock market is crashing right now? You've seen the memes that we've done last week, and the heat map of the stock market was a meme on its own. The entirety of the stock market down almost, and you have one stock, Nvidia, that's up, and that's keeping the S&P 500 higher because it has a large weighting. Nvidia right now is worth more than the entire German stock market. Nvidia worth more than Amazon and Tesla combined. Nvidia soon enough will be worth more than the company Apple. Now you might say, but Nvidia is probably making a gigantic amount of revenue. Not really, it's a fraction of what Apple makes. But this is the nature of a bubble, and it's fluffing up the valuation of the S&P 500. Now, if I'm closer to the retirement age, but not quite, that would make me shit my pants, because what if the bubble pops? By the time I need to retire, I'll be underwater. If the market was rallying in an inclusive, rational rally based on the fundamentals, who would have felt better about the stock market? But when you have the have and have-nots and the great divide in the stock market, with one stock performing and the rest are going down, of course folks are going to feel bad about it and have the impression that the stock market is going down. And this AI bubble, folks, is getting more and more dangerous. If you look at the SOX, which is the Philadelphia Semiconductor Index, to the S&P 500 ratio, we have now reached the same highs from the dot-com bubble. Now, what does that mean in plain English? It means that the majority of the performance of the stock market came from chips. And when you see this huge gap in outperformance, it is indicative of a bubble happening in one sector of the stock market, and that is chips. Well, let's assess here and see whether this bubble is sustainable or not. Well, we talked about this numerous times before, but it goes down to one name, which is Nvidia. We showed you this before, folks. When it comes to these bubbles, they pop once we see the sequential growth of net income turning negative. And that usually happens because something called the law of large numbers. Now, in Q2 23, the net income ballooned higher sequentially for Nvidia to 203%. That was the peak. In Q3 23, it went down to 49%. In Q4 23, went down to 33%. In the recent quarter, that caused the stock to gain what? $250 billion in valuations? Well, the net income growth sequentially was up 19%. So you see the trend here. It is declining. That's called the law of large numbers. What do you think the next reading would be? Let's say up 13% quarter on quarter, 12% quarter on quarter. Can you crash a stock when the sequential growth is up 13 or 12% quarter on quarter? Not really. But at what point do we go back to single digits in growth sequentially or even negative? Of course, the market is going to sniff it beforehand. I think the insiders know that it's just a matter of time. That could be accelerated by the cyclicality of the economy. If the economy gets weaker, you see that growth, sequential growth in net income for Nvidia getting worse faster. And this is why they're giving you the scam of a stock split. Oh, now you can get Nvidia for $100 a share. Well, gee, why is that happening? They can't find a buyer at these prices at $1,000, $1,200 plus. They can't find a buyer. And when I say buyer, somebody who's not an institutional buyer. They're looking for you, the retail crowd. They have to sell to you to cash out. So now they're giving you the stock split so you can get excited and jump in and buy Nvidia at $100 a share because you think it's cheap now. Meanwhile, they're dumping in your head. And the company Nvidia, for the sake of the company, will have to crash their own stock, folks. Why do we say that? The sustainability of the current conditions is shaky. You have the H100 chips. Demand skyrocketed all of a sudden. Supply nowhere to be found. And the spike in demand came from the largest companies in the world, worth trillions and trillions of dollars. Apple, Microsoft, Amazon, Meta, Google. All of these companies have tens, if not hundreds of billions of dollars in cash. They're not impacted by higher rates or whatever the Fed does. They got monopolies and they have an insane amount of cash. They can spend whatever they want. This caused the margins for Nvidia to balloon. They can sell a chip for 50 grand a pop, 70 grand a pop. Well, gee, if they do that, their margins will explode higher. Doesn't take a genius to figure that out. The question now becomes, can they continue to command the same margins? Forget about the competition from AMD and all of that. Put yourself in the shoes of a company like Microsoft. Well, you got billions of dollars to spend. You don't really mind spending $50,000 a pop, $70,000 a pop, if you have to, because we have a race in the AI war. You have to spend to be ahead. But at what point do you think, you know what, if we're spending 50, 70 grand a pop, might as well just do the chips in-house. We can hunt the talent from Nvidia and we can develop all these chips in-house. In the long run, it's going to pay off. And Microsoft, Amazon, Apple, all of these companies have way more power than Nvidia. Now you see that Microsoft is powering the new PC AI chips from Qualcomm. Apple is developing their own AI chips. Microsoft doing the same. Meta doing the same. So Nvidia knew that, of course, that this is not sustainable. And in the new model, the Blackwell, they're going to reduce the prices dramatically. And you already see companies like Amazon halting orders of the old chips, the H100, and they're waiting for the Blackwell because it makes sense. Why would you spend more? But here's the problem with this dynamic and why the stock is going to crash. Inevitably, in the H100 dynamic, the cyclicality of the economy was not an issue. The economy could be in a recession for all we care, a depression. So long as Microsoft, Apple, Google, Meta have the cash, Amazon too, they'll buy these chips if they need to. So there was sort of immunity against the cyclicality of the economy. And all what you cared is you have a handful of customers that you're selling chips at enormous margin to, and you're making pretty good returns. But now you have a dynamic where you have to rely on volume of sales, not the price of sales in the Blackwell dynamic. The bet by Nvidia is when we reduce the pricing, demand will increase, and we can substitute the loss in margins by the reduction in price by the increase in volume of sales. Here's the problem though. Microsoft, Amazon, Apple, the big caps, they're not going to buy more than what they need just because the price went down. This is not hoarders. They'll buy what they need. If they needed 1,000, 3,000 chips of the H100, they'll buy the same quantity of the Blackwell. The question now becomes, can they attract new buyers? Who are the buyers who are going to buy these Blackwell chips? UAE, Saudi, China? They can't buy them, the advanced chips. Other companies? Sure. But now you're reliant on the cyclicality of the economy. Any problem with the economy, read these companies, not the big caps, the medium, small caps are now rushing to buy the Blackwell. Any problem with the cyclicality of the economy, and they're going to stop ordering and spending. And now Nvidia becomes susceptible to the cyclicality of the economy, which the company was shielded from in the H100 dynamic. And the stock crashes. And the insiders will spot that ahead of time and act accordingly. The other problem that we have with what's going on right now with the chip dynamics. Last week, we got these kind of headlines. It reads, China warns of Taiwan war as military drills encircle the island. Now, I always said, folks, that the invasion of Taiwan will happen as a surprise. There'll be a cover for it. Oh, it's just drills or a fishing, whatever. And all of a sudden, Taiwan is invaded. It's going to be smooth, swift, and fast. They'll do it in a day if they have to, because that's the only way they can do it. If it takes longer, now that we have response of the international community. But if you do it fast and swift, now you have to surprise the West with a menu of options. And you gain the advantage this way. And I always said that China's going to invade Taiwan in a surprise. And it's going to be really fast. And now we have the experts agreeing with me. Take a look.
These striking images of Chinese warships off the coast of Taiwan this month, a dire warning of a potential invasion that could disrupt the global technology supply chain, plunge the world into an economic catastrophe, and start a hot war between the US and China. And according to one geopolitics expert, an actual invasion could be over before the US even has a chance to respond.
So a lot of people assume that this would be sort of a Normandy type of beach landing. The reality is that terrain does not allow it.
Dmitry Alperovich predicted the Russian invasion of Ukraine, and now in a new book he lays out how China could seize Taiwan. First, he says, the Chinese would mount a lightning-fast assault from the air and the sea.
You're still going to move amphibious assault ships across the strait. Each of them can deliver about 800 troops and, more importantly, dozens of troop transport helicopters as well as gunships to do an airborne assault. They can reach the two airports within 10 to 15 minutes.
They can do that by parking them in international waters. And Taiwan would feel constrained from firing first because that would be seen as provoking a war.
You're going to have these transport ships, mostly civilian vessels, and have been loaded with hundreds of thousands of troops, armored vehicles, tanks, logistics that you need to occupy an island of 23 million people.
To cover the attackers, Alperovich says, China would strike Taiwan's defenses from afar.
You're going to have bombers launched from the mainland. You're going to have the largest cruise missile and ballistic missile and rocket forces in the world, pummeling fixed radar installations, pummeling naval facilities, pummeling communication nodes.
Then, he predicts, Chinese Marines in huge airboats would rush up the river leading to the center of the capital city, Taipei.
All of this can happen literally within the first 30 minutes of action.
All the while, he says, the U.S. president facing an awful choice.
The bottom line is, any disruption of the manufacturing of chips will pop the bubble right away, because now you no longer have chips to sell anymore. The AI bubble, boom, poof, gone. Now, before moving on, folks, let's do the last segment of this portion of the program, which is the morning brief, today's trading dynamics. What do we see in the market? We begin with my Discord morning brief. Here it is. Good morning. Hope everyone had a great, long, and relaxing holiday. This week, we start with a dynamic of shortened trading week, which usually favors upside activities. The only major macro event we have is Friday's PCE report. We also have a new dynamic that was introduced this morning, which is the 20% plus pop in GME. That's GameStop. To me, it is a distraction that's only fun to watch, and it could be tradable via the IWM. We'll talk about this when we head to the charts analysis. Yet what's important is the upcoming change in volatility momentum. The daily chart of the VIX shows an incoming reversal in the MACD indicator. This information would not be valuable on its own. However, you can see the upcoming change in volatility. This is the chart that I gave you, or excuse me, the change in momentum in volatility. This is the chart that I gave you in the morning. Here's how we closed. So you see the VIX closed positive, and we have a confirmation of bullish reversal in the VIX. Anyhow, back to the brief. However, in combination of an equal weight S&P 500, that is the ticker RSP, also showing reversals in its daily chart indicators. So you can see that in the MACD. This is the chart that I gave you in the morning. You can see the previous look of a bearish engulfing candle that led to more declines in the RSP, the equal weighted S&P. So every stock is treated equally. So you don't have any distortion by Nvidia and the large cap names. And here's the update of the chart. You can see that we went down, breaking trend lines. Back to the morning brief. We are now anticipating the market to change course, beginning with names that have been weaker. This is why I would begin betting on this upcoming reversal using the RSP by the June, or the expiration by June, the 165-160 puts. This trade, ladies and gentlemen, produced over 50% worth of gains today alone. And we think that we have more gains to come. However, it is not the time to bet against the SPY, the Qs, or buy inverse indices yet, until the bigger weighted names like Apple and Nvidia begin to weaken. So we have a strategy here. We see market reversal happening soon. But for now, we're going to stick on that bet via the RSP, the equal weight. Not quite in the heavily weighted Nvidia, Apple kind of ETFs like the SPY and the Qs. That's going to come later. A confirmation of the weakness in the S&P 500 will be closing below the bull to bear advantage line of 5,306 on the E-mini futures chart. You can see on the hourly chart, we almost closed below, but then we got a recovery by the end of the day. So for now, we're still in the bull advantage territory. You got to see a closing below before we begin switching back to bearish. I'm approaching this week with the mentality of managing existing trades, especially upside bets, to look to close them, and then anticipate initiating another major trade betting on a reversal in volatility in market indices. Now, today we also talked about the market dynamics. It was really interesting. By the end of the day, we've seen a flush, then a recovery, and you got to be really careful trading, or let's say day trading the SPY or the Qs under low volume. You'll be at the mercy of the market maker. So we gave you an update before the last hour of the day. We got a mini inverse gamma triggered once the SPY lost 529 due to high open interest in the puts below it. So you can see in the open interest, 529 had about 10,000 contracts. The 28 had over 11,848 contracts. And then if we look at the 27, 26, over 9,000 contracts apiece. So the market maker had to hedge against that by dumping the SPY, just to make sure that if they have to pay these contracts, they're already hedged. They're not going to lose money on it. Here's the problem though. Had the market maker closed below, let's say 527, 526, they would have been obligated to buy the S&P 500 at these levels, because that's what happens when puts are exercised in the money. So now the market maker will try to fight and neutralize some of these puts by pushing the tape higher. However, if downside bets continue to pile in for today's expiration or rolled into tomorrow's expiration, there is risk that the market maker will be squeezed to SPY 525. Why? Because this one has the highest number of open interest, at least based on today's data. Now, this is what happens. This is the market maker getting squeezed to the downside. But we warned you folks, they're going to try to fight it. They're going to try to push the tape higher. They exercise maximum pain. They don't want to pay the calls or the puts either. And you see the pump by the end of the day, and the market closed neutral. The market maker wins again. If you look at the end of the day activities, for the puts, they closed a touch below 530. So they got to pay the 530. You got to pay somebody. But he made the 529, 28, 27, 26, 25. All of these puts expired out of the money. Worthless. When it comes to the calls, closed a touch below 530. And in doing so, you made the 530, 31, 32, all the way to 35. With high open interest, expire worthless. The market maker exercised maximum pain. You got to be careful day trading under low volume. Unless you understand how the market maker functions, you're better avoiding day trading and sticking to swing trading instead with, let's say, longer expiration dates. You're looking further 2 weeks to a month from now, if not even longer. But the day trades will chop your head off, and you'll be at the mercy of the market maker. Now, let's add more color to this conversation. And again, a reminder, this video is in lieu of the public weekend video that we usually produce. So it is longer, sure, and it is public. So please forgive that it's a longer video, but what do you want from me? And if you're a member of this show, I'm not shortchanging you here. Tomorrow, you get the regular programming plus a bonus video. But anyhow, let's add more color to this conversation and segue to the market activities today. We begin with the closing of the indices. And here we go. The diamonds closing in the red, down by 216.73 points, or a loss of 0.55%. The Nasdaq in the green, up by 99.09 points, or a gain of 0.59%. The Spider, flattish, be it positive, up by 1.32 points, or a gain of 0.02%. The Russell 2000 small caps down in the red, losing 0.28 points, or 0.14%. You look at these sectors, all negative in the red, led by industrials, healthcare, defensives. We have two sectors that are positive. Believe it or not, today, energy, beating technology, coming up number one. But we see more gains for energy to come. Then you got technology at number two. Thank you, Nvidia, because the rest, specifically software, underperformed by a lot. The breadth remains awful. The NYSE, 32% advancing versus 67% declining. So is the Nasdaq, only 38% advancing versus 60% declining. You look at the heat map, majority of the market is down. You got some big caps in the green, barely, Google, Amazon. Then you have the AI/chip mania, Nvidia, AMD, ARM, ASML, Micron, Dell Computers for now. And of course, you got the inflationary energy, ExxonMobil, Chevron, the oil and gas companies, and of course, if you look at metals, gold and copper, also inflationary. Those are moving higher. Look at the software names, cybersecurity, banks, cyclicals, industrials, real estate, utilities, the rest of metals, healthcare, defensives. All of these sectors are down. So again, the market is not looking pretty good right here, folks. It's only the AI mania that's holding, and that should scare folks, not encourage them that the market is doing fine, specifically when it comes with a combination of inflation sectors going higher, like energy and copper. We look at the heat map for the ETFs. What do we see here? TLT, TMF down big. That means bond pricing is down, which means yields are higher in a big way. Right off the gate, this is not good for any yield-sensitive name, whether we're talking about the XLP Staples, XLU Utilities, IYR Real Estate, XHB Home Builders, the KRE Regional Banks, the XBI Biotech, although XBI Biotech managed to close a touch in the green because we have a new virus going on, and a lot of biotech names are moving higher. The XRT retail also closed a touch positive, but that's because of the pop in GameStop. Besides that, folks, again, it's all about the chips, the SOXX, the SMH. That's performing along with the inflation names. Gold miners, GDX, SLV Silver, USO Crude Oil, Energy Stacks, XLE, XOP, although I prefer commodities for now. And of course, natural gas, UNG, Boyle, whatever you want to choose, uranium, URA. So you got a combination of chips and inflation outperforming today. The rest, not doing so hot so. And speaking of inflation, let's do commodities. The dollar was flattish for the day, but we see pops across the board led by energy, the WTI closing up by more than 3%. Brent did okay, but underperforming a little bit. You got the gasoline RBOB up, heating oil, natural gas all moving higher. In softs, cocoa, cotton, orange juice, coffee, lumber, sugar, all popping higher. In metals, gold, silver, platinum, copper, palladium, all moving higher. In meats, you got feeder cattle futures up more than 1.5% for the day. On the other hand, you got lean hogs down about 0.5 percentage point. When it comes to grains, folks, sure, you see some downside movements today in soybeans and soybean meal futures. But all in all, if you look at the Bloomberg Agricultural Spot Index, it is actually moving back to the highs. Why? Because we see wheat futures moving higher. So recently, natural gas up 50% from the lows. And then you got OJ trading in as if it is an AI commodity. Now you got wheat also surging higher. So we still have the inflationary dynamic sticking in this economy. At the same time, consumer getting weaker. Combination of both. Stagflation. But the chairman of the Fed says, I don't see the stag or the inflation. Go figure. Moving on to the big casino, the options market, what do we see here? Believe it or not, the volume is still shy. And we wondered about where did the traders go? Did they get annihilated by one mild correction for the year so far? Did they go all in GameStop and got shot in the head? Did they leave because of the summer season? Who knows? But the volume is down all in all, be it they continue to favor calls over puts. And the IV ranks are reasonable, which means that the pricing of options is not really bad. And if we see volatility surging higher, this could be an opportunity to hedge your portfolios or bet to the downside because the puts are really, really cheap at this point. Now, a lot of you brought this up to my attention and you said, what do you think about this? Another Volumegeddon indicator, the VIX Vega 5-year high, only seen before the 2018 Volumegeddon. What does that mean, Vega? Vega is the rate of sensitivity to volatility, rate of sensitivity of pricing of the options. And when we see Vega moving higher, there is an anticipation of volatility. And now we're talking about the VIX, so there's an anticipation of higher volatility in volatility. Doesn't say that Volumegeddon is going to happen tomorrow, but it piles in with the evidence that it's going to happen. Shorting of the VIX, all of these proxy bets against the VIX by selling puts, all of this is going to blow up in our faces again by perhaps a phenomenon even bigger than Volumegeddon. Timing, that I cannot say. If we do the flows here, folks, bullish flows, we got Tesla, DJT, Donald Trump, Dell, Target, SPY, and of course bearish flows, we have the SPX, the cash index, and Nvidia. But be careful here. We use option strat. Link in the description, by the way, 25% off, but you gotta sign in using a website, not your phone. But anyhow, it might be deceiving when you look at this, because when you dig deeper in Nvidia, you'll see that the majority of the bearish flow, quote unquote, is coming from selling covered calls. Folks who own the stock selling calls. This has no meaningful impact on the market maker. What has meaningful impact is buying activities. So if you do the filter and you only do the buy activities, you'll find out that the majority, the vast majority, are buying of calls in the money, out of the money in Nvidia. And that keeps the stock going higher in a gamma squeeze phenomenon. Now, if we look at the unusual trades that I've found for you here, let's begin with the Qs. We have a highly unusual bull call spread. So somebody sees that the rally in the Qs will continue. That could be led by Nvidia. They bought the 463 calls. They sold the 475 calls, all for the expiration date June 14th, spending about a little over $7 million. We have another one for you here for DJT, Donald Trump Media and Technology. Highly unusual, deep in the money. Somebody bought the 30 calls and the 40 calls. Different expiration dates. The 40 for May 31st, meaning this week. The 30 calls for June 21st. Spending about $2 million. They're betting on a squeeze. My 2 cents, this fiasco of the hush money trial or whatever circus going on right now. They think that it's going to be a mistrial. And if that is the case, we'll see the stock popping higher. Here's another one for you for the SLV Silver. Now, somebody here is selling the 25 calls for Jan 1725. This is really interesting because silver been on fire. But this trade is saying, watch out, silver is going to be trading below 30, so 30 is a ceiling. Now, they're not saying all the way till 25, although the trade indicates that might be the case. But the trade will be profitable if silver stays under 30, let's say all the way to June, July. They'll be able to book profits because they collected a credit from selling those 25 calls worth about $5 million. The objective of the trade is to cash in some of that premium, $1 million, $1.5 million, $2 million. So please don't understand that the trade indicates silver will be under 25. All what it needs to do is stay under 30 and the trade will be profitable. Let's move on and do some charts and then wrap it up. We begin with the SPY, the S&P 500, an hourly chart. Anything to see here? Not really. We've been consolidating in or around 529 within the bearish engulfing candle. So nothing to see in the hourly. The bias says that the momentum is probably going to improve. But then you look at the daily chart. And again, you see all of this consolidation. Sure, we got a huge bearish engulfing candle. But we haven't closed below that candle yet to say, okay, we got a confirmation of the bearish engulfing candle. For now, you can still argue that this is a bull consolidation pattern. The problem is you have declining momentum in the MACD, the RSI, the Vortex. Now you see the red line moving higher. Bearish momentum is increasing. So we're waiting for a break one way or the other. And if the RSP is a leading indicator, that's the equal weight once again, then it is pointing out that the break in the SPY will be to the downside. But again, one step at a time, folks. Don't rush it here. It could go either way. One confirmation you can look at is the E-mini futures hourly chart, 5,306. You close below, the bears gain advantage, meaning you have confirmation of the action that we got today in the RSP. You close above, you're still in the bullish bias territory. You look at the Qs hourly chart, much better than the SPY. You can see the weighting of Nvidia and Apple, many of the names that have been performing in the big caps. Doing a bull flag pattern. If we close below 457, then we can talk about, okay, maybe the bears are gaining advantage, but for now, you have to assume that the bull flag will lead us higher. The daily chart, the line in the sand, 460.58. If you close above that, we have more upside coming in the Qs, no doubt about it. If we take the low of the bearish engulfing candle, then sure, we're heading down to close the gap and then down to the 20 days moving average. In the daily chart of the NASDAQ futures, what do we see here? Perhaps we have a rising wedge pattern that's going to break to the downside, but the confirmation is closing below 18,691.25. Absent of that, so long as we're trading above, bulls got the advantage. Bears gain the advantage once we lose 18,121.5, but losing 18,691.25 will initiate a trade to the downside. So we'll be on the lookout. Look at the IWM small caps hourly chart. What do we see here? Gapping higher because of GameStop in the morning, but forming a bear flag pattern, then breaking down, and now we're within range again. Support 202.53, break below, you got more downside. Resistance 205.59, you break and close above, most importantly, you got more upside to come. You look at the daily chart for the IWM, the risk of a topping head and shoulder is still here. Losing the 50 days moving average in blue will be a confirmation of the topping head and shoulder, and we see signs that could be the case in the negative momentum showing up in the MACD indicator, RSI, and soon enough the Vortex indicator. The daily chart of the dollar, what do we see here? Still topping head and shoulder. If you close above the 50 days moving average in blue in or around 105, then we can talk. But for now, dollar still weaker. Is it doing a lot of good for gold? Not really. The old man is waiting and waiting for the next move of the dollar. For now, consolidating in what it at least seems to be a bear flag pattern, indicating more downside to come. So maybe the CPI will come out hotter, or we see the dollar going higher? Perhaps. For now, the risk in gold is to the downside until we see the dollar taking another leg down. You look at the GDX gold miners. Got a retest of the 20 days moving average. Now we're back above 35.74, the bullish confirmation line. I would encourage you, though, that you got to be careful if you're long the GDX. You got to hedge. And you can rent, of course, an inverse ETF such as DUST, D-U-S-T. If we have downside in the GDX, it's going to protect some of your gains. You don't want to buy one-to-one, of course. Just buy a portion to compensate for some of your losses in case the GDX goes further to the downside. And you have to have a stop loss based on what you got in your average price, whether that's 34, 35, whatever you're comfortable with. That would be my hedging strategy. Have a stop loss and rent some DUST, D-U-S-T. You look at the SLV silver. We said last week it was way too hot. Got a pullback. Now it's back to the highs again. It is still way too hot. And the trade we talked about assumes that 30 will be a ceiling. Maybe we're about to form, let's say, a double top and head down the SLV. Not my favorite point here to accumulate a position in the SLV. You gotta cool a little more. This is not good enough for me. Maybe the opportunity, folks, in the next chart in UK oil, Brent oil. We have a closing above the 20 days moving average in white, and we almost have a closing above the 200 days moving average in yellow. Momentum is improving. You see it in the MACD, in the RSI, and the Vortex. So we think that oil could be a trade here. A comeback trade, closing above 85 will be a confirmation. And then, of course, we got the summer season, Russia, Ukraine, geopolitical problems, refilling the SPR, and many more. So I do like oil a little more than silver right now. Better than crude oil, if you look at the RBOB, gasoline RBOB refiners, that's already above the 200 days moving average in yellow. It's about to cross above the 20 in white. You got confirmations in the MACD, bullish confirmation that is, RSI, Vortex indicator. So for now, we do prefer the RBOB over crude, and that means the refiners over the crude oil names. If we look at the 10-year yield, huge pop today, maintaining support at the 50 days moving average in blue and the 20 in white. Momentum in the MACD, as you can see from the green columns in the histogram, showing bullish confirmation. The RSI is in positive divergence, and the Vortex indicator below, the blue line is well above the red, so we have a bullish confirmation there too. Yields are going higher. That's not good for the XHB home builders, which got a rejection today from the 20 and the 50 days moving averages, forming a bear flag pattern. If you've been following my options tracker on Discord, we have a bearish trade in the XHB. We want to stick to that until we hit the lower Bollinger Bands. That's the daily Bollinger Bands. Then we begin to trim and book profits. But understand this, on the weekly chart, we could have more gains to come to the downside, that is, if we have a close below the 20 weeks moving average, because that's going to play out an inverse ABC pattern. The same goes for the IYR daily chart. We have a bearish trade against it too. You got to keep those. Bull flag pattern, rejection of the 20 and the 50 days moving averages. You got the bearish momentum, confirmation in the MACD, RSI, Vortex. We got to keep it all the way to the lower Bollinger Bands, assuming yields continue to go higher. The KRE could be another play. Regional banks, daily chart, bear flag, same look. But the lower Bollinger Bands here are really close, so the opportunities, let's say, not attractive as the IYR or the XHB. The volatility index, we talked about the daily chart briefly in the intro. Let's look at the weekly. Falling wedge, breaking out, Volatility becoming positive again, but the confirmation will be a weekly close above the 20 days moving average in white, sitting right now at about 14. That'll be a confirmation to go along volatility. Big Kahuna Apple, stuck within a range. You got 192 as resistance, you got 187 as support. We got double rejection at 192. We got weakening momentum in the MACD, the RSI. So the odds say that we have a retest of 187. If we lose that, then we have more downside to come in Apple. Souffle Tesla, daily chart been consolidating, doing nothing at all. All of this energy, of course, would be released one way or the other. It could be either way, though. Could be up or down. The Bollinger Bands are getting tighter, so not the most attractive chart right now to trade. You'll find more attractive charts. Please, I'm begging you, stop it with the tunnel vision when it comes to Tesla. A lot of you in Discord keep asking me, time to short Tesla, time to go long Tesla. Why are you stuck with this chart? You got better charts to look at. And here we have Nvidia. Another fantasy when folks see a stock acting in an irrational way, gapping higher above the upper Bollinger Bands, they want to take a short on it. But you have to understand that this is happening because of a gamma squeeze. And you cannot stand in front of this squeeze. You got to see a reversal sign first, bearish engulfing, taking the lows of a previous candle. Then you can take a shot against Nvidia. Right now, it is way too hot. Don't touch it until we see a reversal sign. Now, a play that I'm eyeing on the top in Nvidia in this pattern is the SOXL. This is the 3 times bullish levered index for the SOXX, which tracks chips, Nvidia included. If you look at the weekly chart, the previous high was about, let's say, 57. What if we go to 57 and then we see a sign of topping and reversal? Then I'm going to take the shot against the SOXL as a proxy for Nvidia. And lastly, tulips. Bitcoin, what do we see here in the daily chart? It is still bullish, but it is losing a lot of momentum. All of this consolidation, if the buyers don't show up, the sellers are gonna. We can have a confirmation of that if we lose the 20 days moving average. But for now, you gotta assume that the upside is more dominant until proven otherwise. Let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? The 29th, we have the New York Fed zombie John Williams, along with Atlanta Fed zombie Bostic. All, of course, blah, 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 blah. And then we have the Fed Beige Book. Could be important, but I wouldn't bet on it. And then Thursday, the 30th, we have initial jobless claims. And then we have the GDP, the first revision, the trade balance in goods, retail inventories, wholesale inventories, pending home sales. And once again, more Fed zombies, New York Fed Williams, Dallas Fed Logan. We finish with Friday, the 31st. Most important day when it comes to macro. You got the PCE inflation rate. That comes on top of the Chicago Business Barometer. Once again, folks, I hope that you had a long and relaxing and healthy holiday weekend. We're back, and we'll be back again tomorrow. But for now, this is all I got for you. If you found the information and the presentation helpful, please help us out by pressing the like button, subscribing, and leaving a nice comment. If you're interested in more of our daily coverage, please join us as a member, either here on YouTube or better yet on Patreon. But with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
I love you, but you are not serious people.
Before you forgot my worth, your love for me feels like a rebirth. I don't wanna lose this high, wouldn't wanna lose this high. I just wanna make me yours, I just wanna make you mine. Before you forgot my worth, your love for me feels like a rebirth. I don't wanna lose this high, wouldn't wanna lose this high. I just wanna make me yours, I just wanna make you mine. Enough. I've waited as long as I've lived. Thumbs up. Come get what's yours and what's real. Boot up. Blissful in each other's skin above. Finally risen to the occasion. Past love's forgiven. Made heart space for the one. When it feels right, that's that ascension. Never going back to where